Okay, hello everyone. Today's session is going to be a bit interesting as we move into a slightly different direction from the discussions we've had over the last few days, when we mostly talked about the challenges and the opportunities in the startup space. But what's also important to discuss is what's actually going on behind the scenes in the VC space. So what I'm going to ask is to ask my fellow group of panelists to briefly, in a second, introduce themselves and their funds before we go into a discussion on what is currently going on for VCs who actually fundraise for themselves. To set the tone, my name is Mark Kleiner. I am the Institute Director, the co-founder, and the programs manager of Dream VC. Dream VC is a venture capital institute and an investor accelerator where we train aspiring investors, current investors, and corporates with the launch of new venture capital initiatives. We do so with an African focus and are already present in more than 30 different African countries, having trained over 170 individuals who have now gone on to launch or join funds managing over $5 billion and annual assets under management. With that being said, I'd love to now pass it along to all of our guests. Today we have with us Ghazi, Rita, Kenza, and Rohan to talk about their respective funds and to also share their thoughts on the VC fundraising winter. So maybe we can just go directly.
Thank you, Mark, and hi everyone. My name is Kenza Lahlu. I'm the founder and managing partner at Outliers Ventures, which is an early-stage VC fund focused on Africa. We back companies that are using technology to transform traditional industries across the main sectors, so fintech, logistics, supply chain, and health. And we do that across four of the main regions on the continent, so Francophone Africa. So now we are excited to be coming to Tunisia and investing in this market, hopefully soon. So we do Morocco, Tunisia, Egypt, Nigeria, Kenya. And we started investing back in 2018, and we're excited now to move to our next fund. And I just want to, so the fund name is Outliers Ventures with Z and Ventures, so just to avoid confusion, if you can correct that on the spot, that would be great. But very excited to be here, and thank you for the invitation.
Thank you. Good morning, everyone. My name is Rohan Goswami from Nextera Capital. We are an early-stage VC fund focusing on high-impact technology companies in Africa. We're an emerging fund manager, but we kind of came out of or span out of our Lab 8 Africa Accelerator, which is we've been operating for the past 3 years, and that accelerator is focusing on pre-seed, seed companies across sub-Saharan Africa. So, first time in Tunisia. It's been great. You all are lovely, and yeah, really excited about the potential here.
I'm Rita Zniber, the co-founder, with Selma Benadou of Khalis Ventures, which is a Moroccan VC fund that we have launched 18 months ago. We invest in early-stage startups in Africa. We focus on 5 main industries, the most impactful one for the continent, that are health, agriculture, financial inclusion, also logistics and mobility. And we just invested in Tunisia, and we are very happy to discover what's happening in that part of North Africa. So looking forward for the next contributions.
Thank you, Rita. My name is Ghazi Ben Othman. I am one of the 2 partners that is launching a seed stage fund focused on Tunisian startups developing deep tech technologies. We'll be launching the fund very shortly, probably in the next couple of weeks. Our fund is focused on Tunisian startups, whether they're incorporated in Tunisia or outside, as long as they have their R&D operations in Tunisia, and focused on startups that are developing global solutions, meaning solutions that can be sold in China, in Brazil, in North America, in Europe, and so on. So if you have an AI startup or developing medication for cancer or something like this, you can come and see us, and we'll look at the opportunity. Thank you.
A team effort, as you can tell. So I think to set the scene, a lot of us talk about how 2021 and 2022 was a boom year for funding in African startups. but I think it's kind of difficult to understand what that means without context. Just over 11 years ago, the total tracked funding going into African private startups in the technology sector was approximately $100 million per year. In 2021 and 2022, by some estimates, that exceeded almost $5 billion a year, coming from both international and domestic funds towards the African ecosystem. But that is not necessarily the same trajectory that you see in terms of the funds themselves. The VC fund model requires the funds to raise from an institutional group of limited partners or higher net worth individuals who actually provide the VCs with the money to invest. It doesn't come necessarily from the VCs themselves. And what we saw after 2022 was a certain pullback of a number of international institutions, international companies from investing in African ecosystem through African venture capital funds. So I'm curious, as a question to pose to, an open question to our group, what do we currently think about how the current fundraising climate for the venture capital industry, how has that actually affected your respective funds? And have you had to make any adaptations or evolutions to your fund strategy or your planned fund strategy in the last 12 months?
So I'll start since I have the mic.
No, go ahead.
Okay. So, well, I think first, fundraising for VCs has always been hard. This is something that we need to say, and it's a fact. And VCs are always fundraising, but I think it doesn't happen overnight. So I think you build your strategy and your track record and your positioning, and then you build those relationships with LPs over time. So we are definitely in a down cycle, and we're definitely in winter for VC. But it doesn't mean that VCs are not raising, or it doesn't mean that it's going to stop. For sure not. It just means that it's a bit different and a bit more difficult. But I believe that the best fund will still be able to raise, and will still be able to invest in the right companies. So, the typology of LPs have changed. And those that are, some have, there is less capital going to VC for sure. So some asset allocators are like less excited to invest in VC right now. So maybe family offices and business angels are shying away a little bit. But there are institutions that are dedicated to support and invest in VCs. And they will continue doing that. So I'm thinking about DFIs, or I'm thinking about funds of funds that have mandates for a certain region and that are supporting the ecosystem on the long term. So what I think is important to understand is this is a cycle. And this is normal. It happens, like the economy is going up and down, and the interest rates are affecting what's happening in the VC industry. So just to put it in simple terms, when interest rate drop, capital allocators are looking for better assets to allocate the capital, and assets that will pay back more, better yield. So this is when the venture industry is becoming more attractive, and people are shifting away from mutual funds and more secure asset classes that provide a lower return to more risky asset classes, but that provide a better return, like VC. And this is when the stock market is also, prices are going up, so there is a better potential for startups to exit at high valuations, and then for investors to make more money. So this is when all the money is shifting towards VC. What happens when interest rates go up, then it's less risky, and there is more, the return potential is better for less risky assets. So the money is shifting away from VC and going to those less risky asset classes. So this is what's happening exactly at the moment. So interest rates are going up, and it affects the whole cycle and the whole industry. But again, it's about time, and this is also a great opportunity for the VC industry and VC starting, because it's a great vintage. 2023 is an amazing vintage for new funds starting out in the market, because they will be investing at better valuations. So just to conclude on this, what I'm saying is that it's about building the relationships and doing it long term. And it's not, fundraising is not something that you do overnight. For example, for us, this is the case, and we haven't changed our investment strategy. We are just doing what we've been doing, but adjusting to the current market.
Yeah, just quick thoughts from me. We're currently fundraising for our fund, so we share the same pains as startups raising from VCs. So, just in general, as we're going and reaching out to other LPs, as you were saying, the VC asset class, there's still a lot of demand for it. I think Brighter Bridges, there was a report that released earlier this year saying that the total number of VC dollars invested in Africa definitely decreased dramatically, but the number of deals stayed relatively stable. So that just shows more so about the interest. Of course, longer DD cycles, more careful look on the governance side of things for the startups. But I think there is still a lot of interest for high impact startups in Africa, generally across the continent, and basically matching and making partnerships with fund managers who are doing so. But I'll pass it on to people who.
Yeah, thanks. So for us, it's a bit different because we started investing 18 months ago, and we have raised like a small fund from Moroccan LPs, corporates, and now we are preparing our next fundraising for early, early 2024. And yes, I think that our fundraising strategy, to your question, Mark, has been had to be adapted to the current, the cycle where we are today, whether like startups or VCs, and I think that it's related, and I think that the explanation made by Kenza were very pertinent and well explained. And we are trying to build maybe a mix between first corporates and DFIs in our fundraising strategy, because we think that, yes, of course, they are looking for, all the investors are looking for return, and that's why we try our best to manage the funds. But I think that what's also important is the journey. So the journey as an investor, with your startups, and also your LPs, is also something important for them. So if we talk about DFIs or we talk about corporates, they are both looking for impact. So DFIs want to impact certain regions, and that's also what Kenza said. So they focus on certain regions to create jobs, to have an impact in some strategic problems that this region might encounter. So as long as it's the same thing for also corporates. They of course look for management teams that will secure for them a certain return. But I think they're also looking for management teams that will create and generate values and synergies with their companies, and that's what we trust, and that's what we are going to fight for the next fundraising next year. Sorry.
So in our case, we haven't really been exposed to the ebb and flow of LPs who came rushing to Africa and now are going back, and in terms of their commitments or in terms of their interest for Africa, because of our very singular focus on Tunisia. So in our case, our investors are 100% Tunisian. And what they're looking at is the opportunity to participate in what they see the evolution of the Tunisian ecosystem is. It helps, of course, that we've had one big exit earlier this year in terms of InstaDeep, for example. And so that momentum is still ongoing in Tunisia right now. Also the fact that the strategy of Anava Fonda funds is finally kicking into high gear also means that there's not only our fund that's coming into the market, but also other funds are going to start to participate in this ecosystem. So from that perspective, we haven't really done anything different than we would have done for fundraising during a much more positive environment. It's still about what is your investment thesis, what is your management team, what's the track record, what's the availability of deal flow, and so on. Sometimes it takes a little longer when the environment is a little tougher, but in our case, it still took an enormous amount of time, not because of the main actors, but simply because of the Tunisian administration trying to understand what VC funds are and so on.
Okay, well, this is a really great example for everyone listening in just on how heterogeneous VC funds are. On paper, it might look like a lot of funds are similar. They invest in pre-seed or in seed or they're generalist, but we've had 4 different answers. So Ken's told us a little bit about the market ecosystem and the opportunity cost that comes with investing in VC when interest rates are high. We heard from Rohan and we heard from Rita about how their funds are adapting their strategies to the particular market realities. And then Ghazi nicely shared around the difficulties of starting that very first fund in the beginning as well, when you need to do a lot of market sensitizing. I think what people often don't understand about fundraising for VC is that fundraising for a venture capital fund is very similar to fundraising for an idea stage startup. No matter how fantastic your team is or no matter how much your personal track record is there, quite often you're fundraising on the premise of investing in the future. Unlike a founder who's fundraising with a product, with traction, with some degree of de-risk. So de-risking the fundraising process is consistently one of the biggest challenges for VC funds. And one of the ways they do that is by playing into the unique strengths of the team that give them a unique perspective or unique advantage in investing in the startup ecosystem itself. So maybe we can start from the other side of the panel today. Maybe, Ghazi, you can help us get started with the next one. But I'm curious, how do you think the team composition of the general partners, the founding partners, the leadership in your fund puts you in a good position to be a leading VC fund in your particular focus?
Great question, and I think you will have as many different answers as panelists. So if you had 50 panelists, you'd have 50 different answers. And the reason for that, it's a little bit like VC teams like early stage startups or just startups in a garage are really are very different in their composition, in their how they came about to exist and so on. So I guess what is important to have on the team is as much experience in certain areas as you can, as much entrepreneurial spirit as you can, as much track record as you can. There are no set rules. You can have teams that have a lot of investment experience, no operational experience. You can have teams that have a lot of operational experience and are starting on the investing journey. But overall, the more you are adapted to the solution you're trying to solve, so if you're doing deep tech and your background is accounting, it's not going to work. You can get lucky 1 or 2 times, but it's just not going to be consistent. If you are doing very late stage tickets, it helps to have a very strong financial background in terms of how you structure the transactions and so on. So pick the solution you're trying to develop and then make sure that the team that's going to sell this solution to limited partners or investors is the best one that can sell the solution.
Okay, great. Maybe we can have Rita now continue on your team.
Yes, as I said earlier, we are raising with both DFIs and corporates. And the reason why we are doing that is that, of course, the first fund was raised with corporates first. And second is that we believe that there is a great opportunity in the continent to connect strongly investors, corporates, and startups. And we are doing it also because my partner, Selma, who's not with me today, has more than 20 years of experience in investment banking. She has her own investment bank for now 15 years, and so she's been working with corporates, working on exits and on acquisitions locally, and building relationships between these corporates and their acquisitions. And we believe that we are able to bring the same value as a continuum by connecting both startups and corporates. So yeah, I mean, for me, that's it makes sense for us to build a bigger vision, a bigger fund, by keeping that core competency at the heart of the fund. I mean, both competencies, the one related to startup that we have been building since now 2 years through Calis Ventures, by investing in the continent, by understanding what are the main industries where we need to focus, by understanding what are the startups, I mean the patterns between successful startups, by adapting also to the current cycles that we are living, and connecting these competencies that we have been building since 2 years with the historical competencies of the investment bank that we also have. So these are the two elements that make us a great team for the next fund.
Excellent, thank you. I guess we now have mics going both ways, but yeah, I think maybe we can now hear from Rohan and Kenza quickly, and then we'll go on to the next question around fund differentiation. Kenza, I'll give you this.
You want me to go? Okay. Yeah, thanks, Mark. Yeah, we are coming from the accelerator background. So for the past 4 years, we've been on the continent, and we are using that as much as possible because we are using the same infrastructure that was built through Lab 8 Africa. At one point, we had around a total team of around 40 people that included part-time interns, EIRs, investors, advisors, and all that. So, our goal for that accelerator was to be everywhere and anywhere in terms of finding the high quality deal flow, finding people who are industry experts that can help out within the accelerator and advise these companies. So for Nextera Capital, we just use the same philosophy, the same thesis, and expanded that to a fund. We are a very small team. We're 4 people. We're also very young, but I think that plays to our advantage because we are very flexible. We can be anywhere, in a very short notice. We're also around the world, so I'm currently based in Canada. My partner's based in the UK. We have someone based in Nairobi and in New York. But because we are young, because we are hungry, we can be on the continent and stay for a very long time because this business requires you to meet people face to face, to meet founders, to meet LPs as well. So travel is a big part of the job, but our team is very focused on that. So when it comes to building relationships, I think we have that advantage with our team structure.
So for us, so we are one of the pioneer seed funds on the continent. We've been investing for the past 5 years, and I've been personally on the tech ecosystem in Morocco and then in Africa for the past 10 years. My partners in the US, they have more than 15 years experience in VC, investing in companies in underrepresented and undertapped regions in the US. So we understand founders really well, and we work with them hand in hand. But I think the most important, when you ask VC, what is your value add? What do you provide beyond just money? And I think this makes the difference. And I think our secret sauce and what founders really appreciate about our work is that we really help them first access to the market, which is super important at early stage. So we help them get their first clients. We take our phone, call the C-level executives, and we get them a meeting, and sometimes we go with them. So we really are at that stage of really building this relationship with founders and supporting them as their first backers. And then we also help them scale across different markets. And this is super important because in our markets like Morocco and Tunisia, but it also applies to Egypt, after a level of maturity, they want to expand to other regions, and they need startups in Africa needs to scale at a certain stage, and this is what we help them do. So we open doors and we connect them with other markets, and we build those bridges because we are investing in all of those markets, and we have partners there that can help them enter. And then last but not least, we provide money. We bring in co-investors with us in the rounds. And we also help them get there to Series A and beyond by connecting them and pushing for them for later stage investors that will come and lead the next round, which is super important. So this is how we work with them, and I would say most importantly, we work with care. We care about our founders, and we are there to help and to be their partners. And I think one of the most, the best recognition is that, when our LPs are doing DD on us and they are talking to our founders to get feedback on how we work with them, one of the best things is to hear, oh, your founders love you and they are super happy about how you've been able to impact their growth. So I think for us, it's one of the best recognition, and this is the value that we have in our team.
Perfect. So I know that we are nearing time. So just to sum up what we've just heard from a number of the speakers, it really does speak to the individualism of each fund. But something that I'd really love all the audience to take away is that a VC fund is not about just providing capital. I think quite often we focus on what the startup ecosystem is doing and how unique startups are and what startups are doing, but VCs would not be doing what they are doing unless they really love the startup ecosystem as well, because it's very challenging. And for many VC funds, the way that they operate is not just to provide capital as a source of finance, but to also provide their expertise, to leverage their team, to leverage their connections, to open up their contacts for the benefit of all the startups they work with. That platform strategy is something that we've seen in all the VCs that we've trained, all the VCs that we've launched, and what we see across all the VCs on this panel. While maybe in a more efficient market, it's okay to get by just on the speed of capital, in the African ecosystems where it's very challenging, the uniqueness of each fund is incredibly important. How many doors can you open? Which telecoms do you know? Which banks will support you? Who will invest after you? These are questions that are all incredibly important. So with that all in mind, I think as we move towards the end of the panel, I just want to mention to everyone that yes, we are in a startup fundraising winter and we are in a VC fundraising winter, but winter is just one of the 4 seasons of the year, and in the same way, it's very cyclical. Spring will come, summer will come, and we'll see another winter eventually, but people shouldn't be pessimistic when the underlying macroeconomic fundamentals are very positive. Whether in Tunisia or other African markets, the future is very, very bright, and VCs are going to be the long-term instruments that are going to help make that future happen. Okay, so I think we might have time for only 1 or 2 questions, but at this point, we'll transition to the end of the panel. So thank you, everyone, for your contributions. So do we have any passionate individuals who want to ask a question? I see a hand quite far away.
Thank you. Hi, everyone. I appreciate the quality of the discussion and the panelists, and also very happy to know that it's just seasonal. But I just want to do a little plaidoyer about how we have to learn about the situation, actually. Do you guys think it's a time also that the classic corporate to enter in the market of investment as a corporate VC? Because what you see actually in our global ecosystem in the West, the East, the North, is the exit opportunities are so slow and sometimes inexistent. And do you think one lesson we should learn from this situation is to have like some corporate that have a VC identity to offer, like bank have VC, a random bank have VC identity or VC branch that's also open exit opportunity for fintech companies, for example. I'm telling about it because we are a VC that's very active in Africa since 5 years, back about family office in Hong Kong, and we are doing perfectly well. We are not feeling the winter. Yes, there is winter, but we are not that much cold. Because we are having also some exit opportunity we are seeing here and there in Africa, is because we are corporate, we are on a certain level of economy, and we are engaged in tech economy and green economy, and then we are bringing innovation to the group. Don't you think also it's time that those corporate to be sensibilized of that? It's not about removing the classic VC, but it's about to add a component in the different ecosystem and make us have more opportunity on investment even and also exit opportunities. Thank you.
Okay, thank you for the question. Maybe I'll add some quick thoughts, and then any of the panelists who want to speak on this can. But I imagine this one will not give you that many heterogeneous answers, because I would say it's relatively simple. Yes, of course, corporates have a space to play. To a large extent, the African ecosystem is so immature or so young yet at the moment that we don't see that much corporate investment. But that doesn't mean that the corporate investment is not there or is not willing. You just need to approach it in the right way. Open innovation programs, driving the corporates to understand why investing in startups is strategically useful, and then actually activating those corporates. I'll give you one strategic fact just about the American corporate venture capital market to understand why it's a little bit different. The average top 500 company in the US that has a CVC arm is about 80 years old. There are very few corporates active in most African markets today that can say the same thing. So already the ecosystem is moving quite fast. The fact that we say corporates are slow moving, sure, they're slow moving, but they were even slower moving in some of the more advanced economies. And we're definitely seeing that just anecdotally from our experience. I mentioned we train investors. Out of the 2,000 people that apply for our programs every year, an increasing percentage are corporate professionals, corporate strategists, corporate head of business development, who are thinking, what can the corporate do in the VC market? So absolutely, there's a lot for them to do, but it's a process. It's a design, it's execution, it's management of that process that's really important. And I'd be curious to hear if we have similar opinions across the board.
Yeah, thanks, Mark. I think I take this one as I mean, you've been hearing, we have this very important print in our current fund and for the next fund as well, to integrate corporates in our strategy. And I think that this is a very, an untapped opportunity in the continent, in Africa, because we are seeing some CVCs in Africa, but mainly focusing on fintechs. And I think that there are many other industries that are still, where we lack seeing CVCs, because first, of course, we might have some, we do have some leaders per country, per region, but we also have a lot of, family offices that don't have enough energy or money that they want to spend by building a whole team, a whole department of corporate venture capital. This takes a lot of time, to first build, understand, and then make some mistakes, and then learn where to invest in venture capital. And I think also that for startups, it's not always interesting for them to go to CVCs, because sometimes this can also be a restriction for them in terms of growing, especially if they are, for example, fintechs, or if they are security. Let's take the example of security companies. I have one in mind that that had, as a suggestion, one of the people that wanted to invest was a big corporate, the big bank in the region. But then the startup was afraid, because if she signs with that corporate, she won't be able to sign other contracts with other banks. So I think that it's maybe interesting, and that's what we are trying to not prove, but now we're seeing it happening, that the best way for corporates to invest in startup might be through a third party, which can be a VC, that have no interest, that will make sure that the interests of the startup in terms of governance, in terms of decisions, strategy, will be completely not interested, and will leave the vision to the founder. And then when the startup grows and becomes a Series B and above, then we can imagine something where the right hand of the corporate might invest directly in the company. But I believe that in the early stages, it's very important to have a third party, which is a VC between corporates and startups, so that both interests go in the right way.
Okay, I think just in light of time, I can see a group giving me evil stares from the corner. I think we might be very running short on time, so I'll maybe take one more thought from one of our panelists on this topic, and then we can sum up. Would either of you like to also comment on the topic, or you're okay? No? All right, so in that case, to summarize, to just mention the last points, there is definitely a bigger...
Sorry, Mark, we still have quick question.
Quick question?
It's very quick contribution and a serious question. The contribution is in winter times when there is also new opportunities. In our case, we didn't go to the usual LPs. We went to entrepreneurs who succeeded in Tunisia from their own, who went through the hard thing and said, we would like you to be our LPs for two reasons. Number one, they know what entrepreneurship means, and they could help us really in accompanying our startups. That's number one. But it's tougher for us because they are your friends. If you don't bring them the good, not only you get your family issues. But the real question I want to ask is, how do you see the DFIs behaving? Because I feel that the DFIs don't know where to, are they fund of funds? Are they direct investors? I feel that over the few years, the DFIs are trying to find their own ways as well.
Okay, a bit of a loaded question on how I see. So, anybody feel particularly brave? Anybody want to take this? Okay, in that case, you want to comment? Okay.
Well, I think GFIs they have a mandate to invest in some geographies and in some fund stages. So they have funds. If they have raised that fund and they have already secured it, then they will have to deploy, because remember, it's like VC funds. Once they raise, the clock is ticking and they need to make investments. But I would say they are even more, I think they will be even more precautionous and go slower, and to make sure that the fund managers in whom they invest, they take into account the current situation, and they are able to go into industries or stages that would make sense with the winter. But I think DFIs are still, I think African Invest will tell us a bit more about that later. But I think this is a player that is here to stay, just targeting some specific stages and regions.
Thank you.
Okay, perfect. So to summarize again to the questions we've had, really it's just a question of being innovative, even when you're fundraising. Even as a founder has to be innovative with fundraising. Fundraising for any two startups might not be the same. Fundraising for a VC fund is most certainly not necessarily the same for everyone. There is a big opportunity with activating corporates, but it must be done in the right way. They must be sensitized to the market and attracted to the market for the long term. There's a big opportunity for raising funding from DFIs, but you must be very sensitive and aware of the DFI's strategic aims. You cannot force the VC mandate on the DFI. It's the DFI who can impose a mandate on the VCs. So VC, at the end of the day, needs to adapt and work with the market and fundraise in a strategy that allows the VC to execute on its thesis without compromising its values. But the opportunity is definitely there and there to stay. So thank you very much, everyone, for your contributions and your thoughts. And thank you so much for the very engaging questions. And I look forward to speaking to anybody else who has any other questions on the VC topic and helping you feel a bit more safe in investing in the asset class. Thank you, everyone.
Thank you, Mark. Thank you, Ghazi, Rita, Rohan, Kenza. This was the fundraising in winter times. Thank you. So we move to our next part of the program.